The markets have been falling from its highs from December 2021, and we are looking at a recessionary environment where there are so many good companies at extremely cheap prices. Today we are going to discuss how to find the fair value of a stock in the same way that Warren Buffett does.
Well, intrinsic value is what is the number that if you were all-knowing about the future and could predict all the cash that a business would give you between now and Judgment Day, discounted at the proper discount rate, that number is what the intrinsic value of a business is.
So what Warren Buffett does is he uses a discount cash flow model. So what I'm going to do is start with an example. So this is a simple Excel spreadsheet template that I've created. Don't be worried about the numbers as of now. I'll explain to it in very simple English so you guys can understand it as easy as possible. You can download this template from the description box so you guys can play around with it and put in any numbers, put in any stock data and get the intrinsic value calculator. Okay, so let's start with these for discount rate, growth rate. We're going to ignore all these things as of now. We're just going to do the ticker, which is basically Apple. We're going to focus on Apple stock as of now. The share price and the outstanding shares can be got from any data feed. I use QuickFS and also Guru Focus. There's also Google Finance and Yahoo Finance and many other information. So if you can go to Guru Focus and go to ownership, you will get the number of shares outstanding, which is what I have plugged in here, and obviously the share price as well. So if you can go into the cash flow statement, you've seen the cash flow from operations. So if I can go to the QuickFS and then go to cash flow statement, so QuickFS is free, so you can get all these data for free. So I've taken the past 5 years data of cash from operations, that's right here, and pasted it to here. And then is CapEx, which is short form for capital expenditure, which is basically expense of the property, plant and equipment. I've taken that one and I have pasted here, which is an expense. And then free cash flow is basically the difference of this one and this one. Since already it's negative value, I just have to put in sum here. So 77 minus 13 gives you 64, and that is basically our free cash flow. So this is a free cash flow / discount cash flow model. And growth rate of the free cash flow is basically the final value divided by the first value to the power the number of years. So this one we've taken 5 years minus 1, and that gives you the growth rate. So we've also got the earnings, which is a net income, which again I've copied from the income statement. If you just go down in the net income statement, you can get the values here. So we're not going to use much about the earnings or the net income, but I'll come back to why we have copy pasted this so you guys can use it later. So what's the difference between a cash flow and earnings? So basically cash flow is like the actual cash that comes and goes through you. So let's say your boss pays you £10,000 this month. On paper, he might have paid £10,000, so that will be reflected in the earnings. But on theory, I mean, practically, he probably might not have paid it. Like he might have just given you £8,000 and told you, hey mate, I'm going to pay you back next week or something like that, the rest £2,000. So the cash flow will show £8,000 has come into your wallet and £2,000 is yet to come. So that is why people, including Warren Buffett and value investors like Bill Ackman and Charlie Munger and everybody, focus on the cash flow because that shows the actual amount that has come and gone. So cash flow from operations is like if you're running a restaurant, whatever money you made from the restaurant, from the sales of the restaurant, that is the cash flow from operations. Cash flow from financing activities will be whatever came from like banking or loans and debts and all those things. That comes from the cash from financing. And then cash from investing is basically the capital expenditure or acquisitions and investments and all those things. So we will just be focusing on cash flow from operations and capex and the growth rate. So now I'm going to put in the final free cash flow here, 11443 equals to this one here. Okay. So we got that value as the year 1 free cash flow. So what is the present value of it after 1 year? So what happens is that every year the purchasing power of your $100 or whatever you have goes down. So let's say you have $100 today. That $100 10 years from now is not worth $100. It might be worth just 1/3 that value, and that's where the discount rate comes into perspective. So that is basically you take this one and you divide it by that discount rate. So 1 plus 10% to the power, it's just 1 year. So after year 1, the free cash flow is going to be that. So 101. So you can see the number has reduced from 111 to 101,311.82. So I'm going to do a small tip for you guys. I'm just going to put in dollar here, so because our discount rate is a constant. So we've got the free cash flow here, and you've got the present value, which is the discounted value of the free cash flow. So what happens in year 2 is that every company goes through a growth rate, and that's what we've calculated here. We've got roughly 0.11, which is basically 12%. So I put in growth rate of 12% for the first 5 years and growth rate of 12% for the rest 5 years as well. So what happens is that this free cash flow will grow next year. So all I need to do is 1 plus dollar, 1 plus this one here, and that's it. I'm just going to give in a dollar sign just to put that a constant. So the first 5 years, the growth rate is pretty much, I forgot to put the asterisk here. So next year, the year free cash flow will be 124,000, and we're just going to do this for the next 5 years. So let's see if it has gone through well. Yeah, 139, 156, 175. So from year 6, we're going to use another value. So I'm just going to put this one here, and instead of B7, it is going to be B8. Going to drag all this thing down, and basically you have got the free cash flow for the next years. So obviously the present value has to be reflected as well. So I'm going to drag this down as well. So there you go. So you've got the present value. So you can see that 300,000, which we're going to receive 10 years from now, is basically just 119,000 when you factor in the discount rate. Then what we need to do is we can keep on doing this for the next 10 years, 11 years, 15 years, 20 years. So there's no point doing it continuously for a substantial long time. So what we do is that we take the final value and we multiply it with the terminal value. That is number 10. So this can be 15, 20, or 5 or 8. It's up to you. Universities have done lots of research. We're just going to take a rough measure of 10 as of now. It depends on your risk metric, which we'll discuss in a bit. We also need the present value of that one as well. So I'm going to drag that one into the present value. So we've got this one value here, and all we need to do is we just need to sum all these things, and we will get the intrinsic value of the company. So that's the intrinsic value of the company. So intrinsic share price will be this divided by outstanding shares. So there you go. The intrinsic share price that we have calculated is $144. So what's the current price? Current price is basically the share price now. It's no difference. So what's the 50% margin of safety? That is the intrinsic share price divided by 2. Okay. So we've actually done with our valuation. You can see how simple the valuation is. It's just putting in numbers in there and just calculating the values. So now comes the other thing about conservative methodology and more of a progressive or growth kind of a mentality kind of thing. So if you can see this terminal value, if I increase this number, then the intrinsic value calculation goes higher. So if I keep it lower, then the intrinsic value goes lower. So you need to have like a smooth kind of a measure. So I like to keep it at 10, but again, it's up to you. So if it's a company is kind of like a risky company, it's better off you become more conservative. And if it's not so risky company, then you can go more higher numbers as well. So same thing goes for growth rates. You can see the growth rate is 12%. So that's our rough estimate calculation. So I can change these values as well. So we've calculated 12% growth rate from the past 5 years. So you can do it for the past 10 years, or you can also get some kind of a subjective kind of an assessment, because in the past 12 years, past 5 years, we've been through quite a lot. We've been through the coronavirus, so that has affected the economy and all those things. So economy has been in a difficult situation. So we can assume that this 12% might be a bit underestimating the growth. So if I put in like 20%, you can see the intrinsic share price suddenly goes to $185, you know. So you can play around with these growth rate numbers, but that is up to you really. I would like to put it at 12% right now, but you can change it to whatever you want. So roughly our intrinsic share price is $144. So according to Warren Buffett, he likes investing in good companies. Note the word good companies at fair value. So at the present moment with our valuation, Apple is kind of in a fair value. So buying this company could be a good idea. So on the other hand, if you are investing in a company which is young, like a growth company, then I wouldn't recommend investing at a fair value. I would say you might as well invest in a 50% margin of safety, you know, so you have that room for error, that margin for error, so that all these calculations can be wrong and still there is room for you guys to improve. For example, Manish Babra is a huge advocate for like a massive margin of safety. So there are lots of value investors out there who really prefer the margin of safety. But in order to prefer the margin of safety, you need to know how to calculate the intrinsic value, and that's what this video is all about, to calculate the intrinsic value. Now coming back to the earnings, so why have I put in the earnings as well? So sometimes, especially young companies, their cash flow from operations might be negative because they are spending lots of money. And say for example, I have a restaurant and I'm expanding the restaurant, so whatever money I'm getting from the cash flow from operations, I will be spending it on more property and plants, and I'll be expanding the restaurant from one city to another city, so my free cash flow can be negative. So in that case, calculating the free cash flow model will be a difficult thing to do because we have all got negative values in here. So in that case, using the net income will be far more ideal. So for instance, if you go to Netflix, so Netflix had a negative cash flow a few years back. So if I can go Netflix, you can look at cash flow from operations, you can see there's a bit of a negative value here. So during that time, it's better off assessing your statements by using the earnings and putting the earnings final number here. You also don't need to put the final values of the free cash flow or the net income. You can actually take an average of this. Again, that'll be like a conservative way of doing it, or you can subtract 20-30% of the final value. These are all subjective. You can change around, you can play around with all these things, but this is just the theoretical form of calculating the discount cash flow model. It's all about adjusting your numbers based on your risk profile. Now, just alone doing this is not enough. You need to calculate, you need to find out the return on invested capital, you need to assess the debt to equity, you need to understand the retained earnings growth rate. You need to also know whether the company has got a depreciating asset. Like for example, any of the manufacturing companies, they tend to have higher capex. So every year they'll have to spend a huge considerable amount of money on expanding their factories or maintaining their factories. But some companies, they don't need to. For example, the reason why Warren Buffett likes Moody's is simply because they barely have any capex. So you need to assess not just the intrinsic value, but everything from the debt, from the ownership, from the increase in the growth rate of the sales, the revenue, all these things factor in while choosing a company. But this is just a simple template for you guys to calculate the intrinsic value. So I have made a pretty decent amount in the value-based investing the past few months. In this month alone, I made 24% return. That's for this year. And there's been 1 month, so I was able to buy lots of cheap stock, especially made some great returns in Netflix and in I think Adobe as well. So these two are the big ones that I have performed well. So as you can see, I blurred out some of the things, the total value. You can see this is a real account. The number is here. So I've also got a quantitative based fund as well. So either way, if you do value-based investing or quant-based investing, it involves lots of work. It's just not, it's not that easy. If quant-based trading involves lots of coding and lots of mathematical analysis, value-based investing involves a lot of reading. So you have to read a considerable amount of books and financial statements and annual reports, try to find out small things like contingent liabilities and things like that, because those kind of factors play a huge factor in choosing a company. You need to understand the management. Does the management have any fraudulent behavior? And all those things will factor in while doing a value-based investing. So having a great portfolio of both value-based investing and a quant-based investing would be a great idea. There are lots of data available out there, lots of information available out there, and I hope this video will give you the foundations on how to calculate the intrinsic value. So what I'm going to do in the future is I'll do a balance sheet and also income statement and cash flow statement analysis, so you guys can understand how to read these statements much effectively. So I hope you guys enjoy this video. Have a great day.